So this is Brian Wilson with Market Structure Edge. Today is May 7th. Wonderful to have everyone here today. And as we proceed, as I mentioned earlier, to those that were just jumping on the call, please just keep yourself muted and then just send me messages in the chat line if you would. So I'll go ahead and get started, and I'll probably be kind of moving around a little bit here, so it's probably not as orderly as I would like it. Apologies for that. I was looking at about 7 different topics right before the meeting and trying to decide which ones to cover. So this is what the market looks like right now. S&P 500 down about 30 basis points. It was up earlier. As you all are very well aware, the market has been in rally mode from March 31st going forward. I actually like down days because they can tend to communicate a lot. It's hard to hide your intention on a down day, and let me show you what I mean by that. So S&P down 35 basis points. Let me get to the top of my screen without moving anything. If we look at what's driving advances right now, oh, that's month, sorry, wrong one. So, the whole market lower, as I just showed you, down by 31 basis points. Tech is up a little bit, staples basically flat. Worst performer, energy, that was the case yesterday as well. Industrials joining them, utilities as well in that. What I tend to do, and many of you are familiar with my strategies here, I'll drop and this is a major watch list. I try to drop the main components in the market by market cap, and then I do work for 2 different companies. So some of the companies you'll see at the bottom of the list here are my clients from an investor relations standpoint. But in terms of Market Structure Edge, I'll drop our momentum names over here in the side, and I think this is from yesterday. I don't look at low volatility as much, just to be honest with you. And our passive portfolio, I'll drop the components there as well. So as you're looking at days like today, well, you immediately see a lot of red, but then you see others that are bubbling their way up to the top. It's like, okay, well, it's a down day, but there's buying activity going on. And I just started to do this exercise. I think it's going to be helpful for me. I've started to just track the portfolio. This is our passive portfolio. And what it's looking at is each day, which funds are being exited, which ones we're coming into, and then the current portfolio. So if you look at what is higher today, we have Visa that's higher. Of course, that's in the financials. NVO is in healthcare. You look at AMD, that's, of course, has been on a tear recently. That is down about 3.7% today. Caterpillar down as well. At STX, that is tech, that's computer hardware, that's also down. So it gives you a little bit of a feel for what's moving higher. And I was talking to one of our you guys sent me an email about 30-40 minutes ago in terms of what names do you look at, because sometimes it's hard to parse it out, isn't it? It's hard to figure out which ones do you buy on a given day. And I'll give you an example of what I was doing yesterday, and it's actually still here right now. It's the broken clock, right? You're sometimes right twice a day. This is actually the one that I bought yesterday. And the reason that I bought it is all very similar to today. Almost all the momentum names were lower on the day, but this one was not. It was actually negative. It was down 1.6%, something like that. But from a relative strength perspective, it was stronger than a lot of the other names had been on the day. So sometimes I'll use relative strength, and especially on days like today when the market is down. It's really hard to hide your intentions on a down day. And you can see, money is flowing into certain portions of the market at this particular time. So that's just something that I use for, to help me out. What I will then use, and let me give you a concrete example then. Let's go to the daily trading ideas to show you what this looks like. So if we look at the daily trading ideas and we take Flex as an example, and I usually just sort them by 100% and then moving lower. So you can see that Flex, it's normal volatility, and I really do keep volatility in mind. I don't like getting run over to the tune of 11%. If all of that were to go against me, I feel much more comfortable. And what this means, it's the intraday volatility between lows and highs for Flextronics right now. Here's your entry low, here's your entry high. That's potentially what you're looking at in terms of your entry price, and then your 2% gains would be corresponding prices here. So hopefully that makes sense. I would look at Flextronics at the end of the day because it's showing relative strength. Here's a good example. I was looking at LYB yesterday, and let's see if it's on the list today. Don't think it is, but I'll give you this as an example. So I was looking at LYB at the end of the day, and it was kind of similar today. It was down 3 or 4%. And sometimes I will buy stocks if they're down, all of their volatility or whatever. Sometimes the reasons that they're lower are just kind of bogus. Somebody downgraded the stock, well, that's going to be a fast trading move that's taking it lower. When I was looking at Lyondell yesterday, part of the reason that I didn't purchase it is because so many of the related stocks were down just like they were. In other words, the whole group was down. So if I'm looking for buying something that's really weak on the day, and I didn't do this exercise ahead of the meeting, but if I was looking at WDC or LITE, what's happening in the space right now? Why is it moving? Why is it moving lower? And if there's no good reason why it's moving lower, then I might look at it. But as a general rule, I tend to buy relative strength. That's just me. But that's kind of one way that I'll look at some of the trading. Let me stop for a moment and see if any questions have come in. So I'll stop my sharing, get a couple people into the meeting. And once again, thanks for joining me. This is really a highlight to talk to you guys. So Anesh actually had a great question. I just mentioned that. LITE in Momentum daily trading ideas. Would it be a candidate today as it's just after earnings? So let's go back to that. Let me make sure that I share my screen. Okay, so you can see right away LITE down 7%. And I'll just kind of, I'll do this exercise. I use Google Finance. There's a million that you can use. So you take a look at the news. Falls 5% after results. I might look at the 5-day. What's been happening on a 5-day basis. And Anesh, to be honest with you, I would not, go into this one. You can see that with earnings, it's been under a lot of pressure. I wouldn't touch that. Now, the opposite of that might be a stock that went up a lot with earnings, and I wouldn't chase it on earnings day necessarily, but a lot of times you'll get stocks that move higher, and then they'll kind of give up part of those gains again. But if you see them kind of stabilizing 2 or 3 days afterwards, then sometimes they're kind of preparing themselves for another run, if that makes sense. But LITE, I personally would not touch because it's not It's not consolidating. It's not showing any strength at this particular time. Hopefully that makes sense. Go back and see if any other questions are coming in. Great question from Andy. What's the difference between broad sentiment and SPY sentiment, for example? Terrific question, Andy. Let me go ahead and go back, and I guess I was continuing to share my screen, but we'll take a look at that. All right, so when we refer to broad market sentiment, we're looking at, and think of sentiment as our algorithm for demand. So it's here in green. And what you're looking at then is it's our algorithm for demand for the S&P 500. So, 500 components or whatever, is in it at that particular time, 501, 502, whatever it might be. And as a general rule, historically, the market historically has been moving higher. It tends to run 5.2, 5.3, right in that standpoint. It's currently 4.9. So it just gives you a little bit of perspective. What you're looking at here on this particular chart is when you reach the green line, that becomes the buying opportunity. It doesn't happen very often. In fact, it's only happened once during the course of the last year. The market just doesn't become that extremely oversold. You can see we, came close a few times. It wasn't until recently, in the middle of the Iran war, that it actually went below that standpoint. And we will always get gains afterwards. Sometimes they can be very short in nature. That was a brief blip higher. We still had more work to do, but you can see the tremendous gains that came after that. As a general rule, what happens when we get to the red line, think of that as stretched or overbought conditions. That happens more frequently. You can see, here and here and here and here. What tends to happen from red line to red line, when you go through the red line to when you go back through it, the market average is about 50 basis points. That's the historic average. There are outliers to that rule. We'll talk about an outlier here in just a second, because this has been an outlier. This was about a 4% return, much, much higher than where we're normally at. And I know I haven't fully answered your question, but here in green, our algorithm for demand specific to the 500 stocks. If we, by contrast, when we look at the SPY, it spends most of its time, of course, SPY is an ETF, has a lot of risk management components in there. If we back this up to a 1-year look, it spends most of its time at 5. So almost all the time, SPY is going to be at 5. There are obviously exceptions to that rule. We back it up, I guess, 3 years to see when it moves below 5. And that gives you a good example. We haven't even been below 5 during the course of the last year. But you can see, very brief times when we move below 5. What's part of the reason for that? Well, as a general rule, think of S&P 500 components as being balanced components between value and growth. So since it does have that value and growth component, basically by rule, it's going to spend most of its time at 5. And it gets extended to the upside every once in a while, more often than it does to the downside. But hopefully that helps to explain what we're talking about. Question from Greg, do we pay any attention to the 52-week range? Or is it somewhat useless since almost all stocks are at all-time highs? Part of 52-week range, and great question, Greg. When you consider 52-week ranges and our stocks at all-time highs, that's going to appeal to certain investors, right? You're going to be trend following quants, as an example, are going to be latching on to those types of trades, and you get momentum, and then momentum just accelerates for a period of time until it finally collapses. Obviously, all momentum doesn't continue indefinitely, but in terms of paying attention to the 52-week range, um, I do more from a context perspective. I pay attention more to what's been happening during the last week to a month for names that I'm going to trade. And maybe let's go take a look at the passive portfolio for a moment. And I'll give you an example. So if we look at the current passive portfolio, and by the way, what we mean by these portfolios, for those who are not familiar with them, we keep quantitative portfolios and we track them relative to what's going on in the market uh, for that particular year. If you recall last year, those who were clients, we did not have this fund last year. This is a brand new fund, you know, for our services. Last year, we were looking at other funds, like there was a fund that closely tracked what was happening in big tech. But some of those funds had very poor performance at the beginning of the year. And it wasn't until a couple months into the year here that this really came to the forefront. And what this particular fund is doing, and I'll share with you the criteria, is it's looking for certain market cap ranges. You don't want to be getting into small caps. It's too hard to get out of them. You're looking for good divergence. And what we mean by that is healthy demand and short volume moving the other direction. And then we're also looking for passive money being the key component. Why is that? Well, increasingly passive investment is kind of the engine of the market. Now, other behaviors also have their place. You could do pretty good portfolios with fast trading as well. What we tend to see over time, though, is passive money tends to kind of start a rally, and sometimes the machines or fast traders will then kind of latch onto it, and sometimes they'll extend that rally. But a lot of times, this passive component will be, everything being equal, kind of at the start of a rally. So here's what it's been doing, year to date. Obviously, incredible outperformance on a year to date basis. If we look at that relative to the SPY, 37% right now versus 7% for the S&P 500. And obviously, nothing lasts forever. This could have, this gone straight up here during the last few days. It could go straight back down. There's no guarantees, but just recognize what the criteria is. Now, I was mentioning, how I will approach certain names. And if we look at the current portfolio, so we have CAT, we have AMD, we have some of these other names. Let's go look at AMD as an example. And I don't pretend to have perfect strategies here. Sometimes I will, miss out on rallies because I tend to be a little bit more conservative. But if you look at what AMD has been doing recently, the day that this occurs, I'm not chasing that. It's just me. I'm not chasing that. I'm going to let it cool down for a little bit, and I'm going to watch it from an industry perspective. And then if it does a little bit, if it cools down some, and if you look at supply and demand, and supply and demand is continuing to be strong, then maybe I would consider it. But I don't chase stocks like that. Similar to the Lyondell example that I showed you earlier, if the whole group is moving lower, well, I'm not plowing into a group moving lower. There's a Wall Street expression for that. Catching a falling knife. I'm not going to catch a falling knife. So different aspects going on. I'm not going to chase something going higher. I'm not going to catch a falling knife. I'm looking for kind of that happy medium. Talking about chasing stuff going higher. Obviously, the SOX has been on an incredible rally. Let me see if I can pull up a chart. It didn't allow me to do it earlier, but we'll see if it works. No, it didn't work. That's okay. You guys know the Sox has just been on fire recently. So part of the question then is, how can we know if it's going to continue to show gains or not? And a couple different ways to look at that. Tim actually had a real good point in today's market desk note. He was talking about looking for tells. And this was just an absolutely incredible run when you consider this. So this is a portfolio that I put together. So 30 different components. I have a different one that looks at the top 10, but like when you consider 30 components and you think about the fact that at one point in the middle part of April, 10 out of 10 for a portfolio of 30 to be 10 out of 10 is unbelievable. That just defies imagination, right? That's just crazy. But that's where it was. As we know, the Sox has continued to rally. What have we seen from that point going forward? Well, we had short volume actually moving lower for most of that period. What are we starting to see now, though? Well, we're starting to see short volume creeping higher. Nothing's perfect, but if we look at what the Sox is doing today, well, it's down 3%. There was a little bit of a tell there with short volume starting to increase that, maybe I should, if I've been in the Sox or individual names, maybe I should kind of step back or not be as aggressive, at these levels. Let me stop sharing, see if we have any other questions. We'll take a look at Flex. Great question from Richard. Tim often speaks of the underlying basket not reflecting the SPY. Any suggestions on navigating our way through this? That's a great question, Richard. I'll see if I can give you any credence, or we'll take a look at that. I don't know if I have a perfect answer for that, but we'll take a look at that here in just a moment. But let's go ahead and make our way over to Flex for a moment. Okay, if we look at Flex, and just as a reminder, I think we were looking at that earlier. It's in our momentum portfolio today. It's up 46 basis points. This is kind of the exercise that I'll do. It's showing relative strength on a down day. You can see that today there's that relative strength. Who knows what happens in the last hour? Probably goes up. Don't know for sure. I'll take a look at. Do I see any significant, news in the name? Obviously, we had, earnings coming out and what have you, recently hit all-time highs. So, those are some of the things in the background when I look at that particular name. When I look at it from a supply and demand perspective, well, there's that move, real, obviously huge move higher. So we went from 96 up to 134. In terms of, do I plow into that one today? Probably not. I probably give it another day or two. It's kind of consolidating its gains today after that big move higher. So far, it's doing okay. If you are a risk taker, I would suggest maybe downsizing your position size a little bit more, because this is a very, very large move higher. I'm not opposed to moving into those shares, but me personally, I'd probably wait another day or two. That being said, it'll probably be up 10% tomorrow, and you're like, thanks a lot, Brian. I missed that move because of you. But that's just I'm more conservative. That's just my nature. Apple, I wanted to share with you Apple because it's approaching all-time highs. And Richard, I'll go back to your question here in just a moment. Approaching the $300 level, does it have the potential to break out? Sometimes I'll back a chart up a little bit and take a look at, where we've been historically. When Apple was doing really well last year, notice demand, and recognize that this is very normal for demand to wax and wane in the marketplace. So demand, just hot, 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 hot. And then at the beginning of the year, well, it fell off, and big tech fell off. Almost all of the big tech components would have looked very similar to this one. What do we see here? We saw an attempted rally. Sentiment got back up to 7, but you can see it didn't get back up to 10 again. What happened? Well, it fell off. Where are we right now? Sentiment up to 6. So it's trying to make a charge again. I think personally, if I was, betting on Apple, I want to see it get past where it was before. It's not really a technical indicator, but this is most recent trading. And, can it have a healthy charge back up to 10 again? If it does, you can see, it plows higher in that environment. So just an example of maybe something to think about with stocks that are approaching all-time highs. Where are they from a supply and demand perspective? And, what do they kind of do historically? Richard, to your question, and let me go back to that so I can read it one more time. Tim often speaks of the underlying basket not reflecting the SPY. Any suggestions on navigating our way through this? I think part of that, and terrific question, what's happening underneath the surface? And obviously, if we look at recent trading activity, a lot of the baskets have been been heavy in terms of the stocks and big tech components, right? So then I circle back to, what are those doing right now? If they're going to come under pressure, or what's the potential for them to come under a little bit of pressure? Let's start with the stocks. We looked at that already, and we note that for the semis, they still have good relative strength. That's 6.9. If sentiment here in this portfolio would start to stabilize and short volume moves lower, well, stocks probably continues to rally. And part of the exercise that you have to think about is from a market cap perspective. And this is what the S&P 500 looks like right now. So you're looking at the top 15 components, and this is 45% of the S&P 500. As you can tell, most of it's dominated by big tech. That's why we tend to focus on big tech. But you can see a couple of these names have made their way up, up the chart recently. They don't have the same weightings as these do. So as a general rule, as you've heard me say this a million times, but as big tech goes, well, so goes the market. So if we think about that, well, how is big tech going then? And right now it's actually doing pretty well. Once my screen comes back up. So big tech itself, and as a general rule, what tends to help me is I'm looking for alignment, and I'm looking for alignment between big tech sentiment and demand and broad market sentiment and demand. Big tech's actually really good right now. You can see that we bottomed at 5.9 and we're starting to move higher again. And short volume actually moving lower. So the component for about a third of the market cap for the S&P 500 is actually in pretty good position at this particular time. If we're looking at the broad market itself, short volume is really, really good. The rate of descent or decline for broad market sentiment is starting to slow. This is a 5-day moving average for what you're looking at there. If we move behind the scenes for a moment, let me see if I have it up. It'll come up here in just a second. So we basically bottomed. This is a daily look. There's what you're looking at for broad market sentiment. We're actually starting to move higher on a daily basis. So that means that this look here probably bottoms in another day, maybe 2 days, and short volumes moving the moving lower. So you're getting alignment there in terms of that activity. Richard, I probably didn't fully answer your question, but I'm looking from a context perspective, what's been happening in the market. Where's the leadership recently been coming from? Recognize sometimes for some of that leadership, then you're going to at some point get ETF market makers who are going to start taking profits. Are we starting to see that in the stocks right now? Perhaps. So recognize that that's a possibility, and sometimes for a period of time, that can kind of put the kibosh on on market gains. But then also recognize what's happening behind the scenes. And at least right now, big tech continues to look pretty strong. All right. Thanks for the questions, guys. These are terrific. In terms of some of the strength today, boy, this is a tough one. And where I'm going is with software stocks. And let me share my screen before I forget to do that. And if I ever forget to share my screen, just yell at me, because I will forget to do that sometimes. A good proxy for software, which has just been destroyed year to date. IGV is a pretty good one. And it's just been under so much pressure. And what has been happening recently is you get a lot of pressure, you get a move higher for like a week, the whole group comes under pressure, and it's just back and forth and back and forth. And it's been excruciating in terms of, watching that space and trying to trade it. I've traded it a few times, and I've just had to be very nimble in terms of going in and taking my profits, because it's just been very, very unpredictable. Same thing happens here, move higher, this move lower, and I know we're looking at price here. I'll show you demand here in just a moment, not as bad to the downside as some of the other ones that we've been seeing. So what's more important, of course, than price is to actually look at supply and demand. And, just as a reminder, you can form these portfolios. It's very simple to do so. You can form static portfolios, and, you can do any type of search. Show me the top 10 software stocks, and you can plug in a portfolio in that manner. But let me show you what's happening with supply and demand. And, in this space, I might try to go long again. Once again, you probably have to be nimble, but I'll show you what's happening. And I need to delete some of my portfolios that I don't use as often. So here's what's happening in software stocks. We're getting kind of that stabilization and sentiment just starting to creep higher again. One of my clients on the investor relations side is Progress. This is a list of their peers. You can see they're actually doing much better at this particular time. Another one is Zscaler. Their sentiment's actually pretty good as well. You kind of put that together, and you're like, maybe there's some potential there, and especially if you get like an extended rally, what we saw back in the early parts of April. So I'll stop sharing again and see if we have any other questions that have come in. Looks like I'm doing a very good job of totally confusing everyone today, which is great. That was my purpose for today's live discussion. I'm just joking. We talked about passive money. Let me share one item with passive money, and then we'll kind of take a peek at the look ahead. So passive money, of course, doesn't care about fundamentals. They care about characteristics. What do I mean by that? They're looking at things, and this is one of our modern IR charts. But think about the passive buckets, if I can use that term, as we think of it as index funds, ETF. They're picking up shares in a company because of the characteristics of that company. So usually it's market cap, it can be sector, it can be volatility. Sometimes it can be for leverage. But look at what passive money has been doing the last few years. So this was a chart from 2023. Passive money was about 22% of daily trading. So what we mean by that is if something trades 100,000 shares, passive money would be 22,000 of that on a daily basis. 2023, take a look at where passive money is now. So this is our S&P 500 chart, and here's passive money. That's a big number. So it's now up to 26% on a 200-day range, and it's up to about 28% now. What does this tell you relative to 20 and 50-day trends? Well, passive money's in there. It's been a price setter. If down at 24%, obviously that would be just the opposite, and maybe that would communicate that, hey, we're not getting passive investment flows at this particular time. Maybe the rally doesn't have any legs to continue, but what we're looking at right here is continued good passive investment support that's just growing over time. Anesh, thank you for the compliment. He said the B team was great. Every once in a while, the broken clock principle does work. In terms of the road ahead, I'll share just a couple of things with you, and we're kind of moving up to the end of our time. We'll circle back to what was happening with big tech. We'll try to keep the look ahead simple. And broad market, I think, probably bottoms in the next couple of days. And if short volume continues to move lower, then we have divergence from an S&P 500 perspective. That is conducive for further gains. We looked at big tech already. Let me share with you what's happening from an outlier perspective. And I mentioned this move higher was an outlier. This is fascinating. Sometimes what can happen with outliers, and we don't have a lot of examples to share with you, but looking at periods where we've moved above that red line, you can see almost every time recently, gains fizzle out. That's very, very normal. This is a spreadsheet that goes all the way back to 2020. The purpose of this spreadsheet is just looking at what happens when we move above the red line. There's that average. We tend to average about 60 basis points in the market. There's the most recent period. That was a huge outlier. If we look at outliers in the market and then recognize these are central tendencies, other things can occur. But if you look at the times where we've had huge movements higher, well, we tend to hold on to those gains afterwards, or the market moves sideways. We don't tend to see huge losses afterwards. Almost every time where you see that green, you continue to see movement higher, in the periods afterwards. Here's where we're at right now, still kind of waiting to see, what we do afterwards. One other component, and this is what this spreadsheet is showing you, is an outlier in terms of big tech. So when big tech sentiment gets red hot, and here's what I mean by that. So if big tech gets above 8, it doesn't do it very often. It did it through here. So when big tech gets above 8, it historically, and I don't have as much data going back on this one, it goes back to 2024. we actually tend to cool down a little bit, and then the market tends to continue to advance. The last time that we can see similar performance actually goes back to after the tariff tantrum. Uh, Big tech was strong. It continued strong afterwards. Big tech recently has been strong. What will it do afterwards? Well, we're finding out, as we speak. But I would say central tendency would probably continue to move higher. So that's kind of my look ahead. Is I'm expecting things to continue to move higher. We might get a little bit of rotation out of the semis, and maybe that slows things down a little bit. So that would be one area to monitor. And if you don't have that portfolio, you can probably, put it together in 10 minutes tops. So just go and grab those semi components, put it in a portfolio, and then you can watch it every day. And then, especially if you start to see stabilization here, along with stabilization in the broad market and in big tech, well, you're getting alignment everywhere. The market's probably going to continue to move higher. Uh, so guys, I think that is it for me today. Any other questions that I can address for you guys?